Hello and welcome to our 2020 Charter Hall Direct Market and Fund Update. Thank you for joining us as we provide the latest update and insights from Charter Hall as well as senior industry professionals. For those who don't know me, my name is Steve Bennett and I head up our direct business at Charter Hall. I'll also be the moderator as well as have the pleasure of being one of the presenters today. You'll see on the screen an important disclaimer. Whilst we always want to educate and inform our audience, we are not in a position to provide financial advice. If any of the funds or products that we talk about today are of interest, I would strongly recommend that you speak to your financial advisor and you read the offer documents in full. Now, with those formalities done, our first speaker, David Harrison, is the Charter Hall Managing Director and Group CEO. With a specific focus on strategy, David is responsible for all aspects of the Charter Hall business, is recognised as a multi-core sector market leader and has over 30 years experience in global property markets and has led transactions which have helped Charter Hall grow from $500 million of FUM up to $40 billion as we stand here now. David is also the Vice President of the Property Council of Australia, and he'll be embarrassed for me to say this, but last year, according to the AFR, was the most influential property executive in Australia. We'll now welcome David Harrison.
Good morning, everybody, and welcome to this morning's conference. And very happy for all of the audience to get the opportunity to speak to the various executives and experts in the sector. As Steve said, I've proudly led this company for the last 6 years since we were a little private business. We listed on the stock exchange in 2005, and we've grown to become the $40 billion property owner and manager in Australia, second largest to Westfield by value, with over 1,200 properties. And we're very proud to be offering all of our investors a diverse range of commercial investment opportunities across sector-specific industrial and logistics funds, office funds, and diversified investment opportunities. There's no doubt we've been through an unprecedented few months, both from an economic point of view. Clearly, this has been a health pandemic. It's very pleasing to see Australia has managed the health risk very well, and I commend all levels of government on their leadership in that regard. From our perspective of Charter Hall, for over a decade, we've been leading 2 or 3 thematics that I'd just like to touch on today, which have put us in a very strong, resilient position to navigate the pandemic and also to navigate and provide our investors resilient dividend yields coming out of their investments with Charter Hall now and into the future. A few of those thematics that are important. The first one is we've really led the charge in what we call long WALE property investments. WALE is an acronym. WALE stands for weighted average lease term to expiry. In simple terms, it means the average remaining lease term on certain contracts with our tenants. Many of our long WALE assets and portfolios have maintained their WALE despite the effluxion of time due to the active asset management of our team in being able to extend those leases and then grow those portfolios accretively with new long leased assets. The other thematic that's very important to us and has been for a decade is to focus on tenants who are leaders in their industry. We want to have resilient tenants. We want to have tenants that grow. We want to have tenants that take advantage of cyclical opportunities. So when you go through and look at our tenant register, you'll see the leading brands and the leading tenants in each of the sectors. One of the third thematics that we have focused on in the last decade has been a very strong focus in industrial and logistics, and within that portfolio, focusing on non-discretionary retail and supermarket anchor tenants. We're now the largest landlord to the 4 major supermarket operators in this country: Woolworths, Coles, Aldi, and Metcash through their IGA network. That's not an accident. That's been a deliberate strategy with over $10 billion in industrial and logistics. To have nearly 40% of that leased on long-term leases, those 4 major supermarket operators. And as you would have all seen through the health crisis we've just been going through, we have all, I think, seen the value of non-discretionary grocery-anchored retail. From a sector perspective, we've always been proud to be able to offer our investors an exposure to industrial logistics, office, and one of the other sectors that has become a dominant part of our $40 billion portfolio are long WALE convenience retail assets. That has been, if you like, reflected in a series of transactions that we've conducted over the last 10 years, with long leases to Woolworths, long leases to AP Eagers in the automotive sector, long leases to the major dominant service station operator in BP, which we announced last year. But we've also been doing this in less known sectors, people like Suez, which is a major waste management company. What you'll realize during all cycles, waste management is still going to be a critical part of all economies. I think there's a lot of talk around what is the future valuations in property. What I can say is that despite the volatility in the stock market in all sectors, including real estate, what we're seeing with that long WALE resilient thematic, that our asset valuations are quite stabilized. Many of our long leased portfolios continue to see valuation growth during this period. Many of our customers have actually benefited from increased sales during that period. I mentioned supermarkets. We're also a very big believer in Bunnings as the dominant retail player in hardware. I think you would have seen from Wesfarmers' recent results that business continues to thrive. The other thing that's important is that when we look at all of our sectors, we've had a very strong focus on not only strong corporate tenants, but also government tenants. You see that manifests its way in the high exposure to government tenants in assets or funds like our PFA office fund. Likewise, in our direct office fund, and some of our industrial and logistics portfolios also boast long leases to government tenants. The other thing I would say is that during the volatility we're seeing in the stock market, and given that we're virtually all getting negative real returns by investing our cash in term deposits, we see the 5.5% to 6% dividend yield that you can get from investing in unlisted property with some rental growth, and ultimately we believe there'll be stable capital growth. That's going to be, in a relative sense, a very attractive place for investors. We, as the largest manager of external equity investing in the commercial property market in Australia, are seeing equity flows from all sorts of segments. We continue to get flows from Australian superannuation funds. We continue to get strong inflows coming from global sovereign wealth funds, global pension funds, global insurance companies. We recently announced a joint venture to buy the $648 million Aldi logistics portfolio on a triple net lease back to Aldi, and we brought in a joint venture partner called Allianz Real Estate, one of the largest global real estate investors in the world. And that partnership was a partnership between Allianz and our large wholesale industrial fund. So that's just giving you a bit of a snapshot of where global equity flows are seeing, or what we're seeing in terms of appetite. What I always find remarkable about global investors is they don't need to invest in Australia. So when they do, and they're telling us that Australia is still rated as one of the highest priority markets for them, that tells you on a relative basis, the Australian economy and the Australian commercial property markets look attractive relative to many parts of the world. So those of us that live in Australia should see that as quite a compliment for the growth and the resilience of the Australian property market. Lastly, from my perspective, we have nearly 600 property professionals in Charter Hall. It's been in our DNA from our foundation in 1991 to manage other people's money with care, focus, and two thematics that are very important to myself and the whole executive team: growth and resilience. So everything we do here at Charter Hall is about protecting the capital of investors, giving them, as I said earlier, a good dividend yield from their investments, but also focusing on providing continuity of cash flow and to provide some modest capital growth to complement those very attractive distributional dividend yields. So for me, just in wrapping up, I would just like to give you confidence around your investment in Charter Hall, confidence around any prospective new investment you may make. We think the property markets are in a solid position, despite the fact that there's no doubt there's going to be some challenges economically. We think good quality, unlisted commercial property will outperform over a long period of time and will provide that low volatility, sleep at night type thematic that I think has held our unlisted property funds in good shape over the last 30 years since Charter Hall was founded. So for me, once again, thank you for taking the time to dial in and listen to the panel of speakers today. And as Steve said, if there are any questions, please reach out to any of the people at Charter Hall, and we'd be more than welcome to have discussions about your appetite and how we might be able to provide a sensible investment solution for you. So for me, I'll sign off now and wish the rest of the panel and the audience a good day listening to the expertise that's on offer.
Thank you for that update, David. I'd now like to introduce our second speaker, Andrew Ballantyne. Andrew joined JLL in July 2007 and is the Head of Research for Australia. He manages the largest and most diverse property research team in the country, covering commercial, residential, and alternative real estate sectors. Andrew is a well-respected commentator and analyst in the commercial property industry. He's widely quoted in the media and presents at industry events, often hosted by the Property Council of Australia. I'd now like to hand over to Andrew to provide insight on the next normal for commercial property.
Thanks for the introductions, Steve, and welcome to everyone who is dialing in to this virtual event. As Steve said, the topic that we've gone with today is exploring the next normal for commercial property markets. And I wanted to articulate what that next normal may look like through essentially three questions. These are the sorts of questions that we're getting from investors at the moment in terms of their own thought process to navigate a post-COVID recovery trajectory. And the first of those is, will COVID-19 have a significant impact on office sector demand? The second question that we get a lot of is, what factors are contributing to the resilience of the industrial and logistics sector? And the third question is, how are we interpreting the conditions in the real estate investment market? So let's start with the first question around the outlook for office sector demand. And let's just start by looking at the short-term outlook. And clearly, given the health crisis has manifested into an economic crisis, we have scaled back our net absorption or demand forecasts for 2020 and 2021. What I'm showing you here is actually the shift in forecast that JLL made in January, pre-COVID-19, and then post the announcement from the WHO that COVID-19 was a global pandemic. The numbers that sit above the bars essentially show that shift that we've made in those demand forecasts for 2020 and 21 aggregated. So you can see that we have made some significant downward revisions for office sector demand over the next 24 months. Some of the factors that we're looking towards specifically are the potential for tenant downsizing, an increase in sublease availability, and also as we move into the latter part of the year, the potential that the business failure rate will start to increase. What's going to be really interesting is the level of leasing activity that we see. Typically in a downturn, we see much lower levels of leasing activity or day-to-day leasing activity. So that tends to say that owners of existing assets actually tend to report higher tenant retention rates during periods of downturn, given the level of uncertainty that some organizations have around their potential future headcount growth. Now, that's the short-term outlook. There are some bigger thematic questions, I think, that need to be explored around the office sector. The first of those is around the whole work-from-home story. We've heard a lot of large organizations, largely US tech firms, come out and give directive to their people in terms of how long they can work from home. Now, JLL has undertaken a global survey of 3,000 people. These people work for multinationals, and we really wanted to understand their work from home experience in terms of how that actually shapes their attitude towards workplace. And when we asked people if they missed the office, 59% of them responded that they did miss the office. Now, this wasn't a binary question. This was actually done on a 10-point scale. And to qualify as being part of that 59%, you had to actually rank an 8 or higher. We also saw a number of people that actually ranked at around 6 or 7, which would increase that overall observation. What's really interesting, though, is when you start to drill through the different demographic cohorts. So we found that people that are less than 35 years old actually miss the office even more. And that again points towards the millennials, the Gen Ys, the Gen Zs that are now coming into the workforce, that desire for socialization, that desire for interaction with their colleagues. And when we asked people specifically what they missed about the office, that came through in the results quite strongly. It was really the people that they missed. They missed that human interaction. They missed the collaborative environment that they have within their workplace. And it's actually interesting, they provided a very diverse range of answers in terms of what they ultimately missed. We did ask them about what they enjoyed about working from home, because we think this is really important for organizations to understand moving forward. And the overwhelming response came back that they enjoyed not having a commute. They enjoyed the flexibility, and they enjoyed what they saw as an enhanced work-life balance. So we think that there has to be a greater alignment between the head of people, or HR, the CFO, and then how that flows through their corporate real estate strategy. And we as a house believe that we're going to start to see an evolution of what we call the hub and spoke model, where large organizations actually have multiple locations and they truly understand where their workforce live. They understand where their future workers are likely to live based on demographic trends, and they have multiple locations, whether that be in the CBD or whether that be within certain metro markets. And work from home will become one of those spokes as well. The other thing that I think is really interesting in the whole work from home discussion, and I've certainly seen this through talking to a number of clients, is the whole organizational culture piece. Now, Edgar Schein is really the main proponent of research around organizational culture. And Edgar Schein talks about 3 layers of culture. He talks about the artifacts or the visual elements of culture. He talks about the espoused values of the organization. And you can think of the words that a lot of companies use. They talk about collaboration. They talk about teamwork. They talk about customer obsession or customer centricity in terms of some of their values. And then you've got the deepest layer of culture. And to me, that's the most interesting part of culture. And it's what Schein termed basic assumptions. And I think it's interesting when you have organizations that talk about the collaboration, ultimately that customer centricity, having the collaboration to create new products and new ideas and new services for their clients. And to me, that's the key role that Workplace has. Workplace brings people together and allows that collaboration, that interaction between them, and that's how new ideas are generated. So while we can certainly, we're probably all better now in terms of using technology, I still believe that Workplace has a very strong and important role in terms of ideas generation moving forward. So how do we expect to see the market recover from a numbers perspective? And what we've got here is essentially looking at net absorption cycles going back to previous downturns, going back to the early 80s recession. And in terms of interpreting this graphic, year zero is the bottom of the market. Year zero, as I said, is typically when you have an increase in sublease, tenant downsizing, business failure rate. And as we said earlier, we've already revised down our numbers for 2020 as a result. 21, or year one on this, tends to be the first phase of normalization. And then you tend to get a recovery in year two and year three. If you look at the dotted black line, we're being fairly conservative around what that recovery looks like. And we're actually below the recoveries that we saw in the 80s recession, the 90s recession, and ultimately the post-2000 slowdown. I think what's really interesting when I look at this chart is that the economic ingredients of every downturn are always very different, but the way the office market behaves has been remarkably consistent. And if you think back to that post-2000 period when we had those horrific events in New York City with the planes going into the Twin Towers, there's a lot of people were saying at the time that companies, individuals are not going to want to work in high-rise towers. You can count that there's a very large number of high-rise buildings that have obviously been built that are higher than the World Trade Center since that time period. And even going back to the early 90s, I was speaking to my predecessor, and he was saying, with the launch of the World Wide Web, there was the view that people didn't need to use workplace or use office space the same way as they did. So we've had these discussions before. I don't want to come across as almost sounding flippant about it, because I do think there will be some interesting changes. But I may borrow Jean-Baptiste Alphonse Cata's phrase, and he talked about the more things change, the more things stay the same. And he said it in French, and he said it in a better accent than what I've just said. But I do think it's interesting. There will be some cyclical and structural changes. But if you look at the place that Workplace has, we still think that has an important role for organizations due to the culture piece. I want to then start to think about some of the sectors that we're looking at. And this is where we do expect to see some structural changes in terms of the composition of tenant demand moving forward. So I've identified 6 industry sectors or industry subsectors that we're watching very closely. Right in the middle of the screen there is the digital economy. I think it's interesting when we look at technology firms. The NASDAQ's just come back a little bit, but the NASDAQ had already reached its pre-crisis peak last week and is obviously trading at a very high level. We're probably less interested in those NASDAQ-listed companies because a lot of them already have representation in Australia, but it's that next wave that's coming through. And we're having discussions with a lot of the venture capital funds based out of the US and the West Coast in particular, and they're looking to identify those next organizations that are going to have an impact. It's quite intentional that I've got health and public administration either side of the digital economy, because to me, there's actually quite strong linkages in terms of how we're seeing it at the moment. If you looked back in the budget papers of last year, you would have seen that the Department of Defence was a strong growth area for the Commonwealth, and cybersecurity was one of those areas where they were seeing strong growth. What we've seen over the last 12 weeks is a real acceleration in the number of cyber attacks on public entities and also on private sector organisations. So we continue to see that as a growth area for the Commonwealth of Australia around that broader cyber piece and how that plays into tech and the digital economy. Then on the right, we've got health. Now, coming out of a health crisis, we expect to see an acceleration of the take-up of space from healthcare-related companies. We were actually talking about this pre-COVID, and if you look at the US in 2018 and 2019, healthcare was the 4th largest industry sector contributing to US leasing activity. In Australia, it was about 7th or 8th. So we were expecting to see more activity from this sector, but as I said, coming out of a health crisis, that will accelerate. The other thing I think that's interesting is this concept of health tech, which is around the creation of vaccinations and other healthcare related products. we already see clusters of those sorts of industries based in areas like Kendall Square and Cambridge, Massachusetts. And we expect to see a greater evolution of that clustering of the healthcare and related sector in Australia moving forward. Looking at the bottom row, you've got some what I'd call probably more obvious candidates. Right in the middle there, we've got mining. The iron ore price went up to 103 US dollars a ton last night. We know that that's partly due to some disruption that we've seen in Brazil in terms of supply. But I do believe a lot of economies around the world will be focused on infrastructure spending in terms of re-accelerating that reopening of the economy. So that should be positive for the export of iron ore. And then on the other side, we've got supply chain management. I think that's going to be a really interesting area to watch. We tend to think about more in the context of retail and industrial and logistics. But when I look at the type of professionals that they're going to be involved in supply chain management, I can't really see them sitting in warehouses out in Western Melbourne and Western Sydney. They're more likely to be sitting in some form of office accommodation. I'll leave manufacturing to the side because I think that's a relevant discussion when we get into industrial and logistics. So as I said, that second question that we're getting a lot of is, why is that sector being so resilient? And there's really 3 or 4 areas that you can point to that support that resilience. E-commerce probably captures too much attention on the overall sector relative to its footprint, but it clearly is a growth sector of industrial and logistics moving forward. If you look at Australia's pre-COVID e-commerce penetration rate, it was sitting at 9.3%. On the NAB numbers, that's already jumped up to 9.6. The global average is around 11.9, and the US and the UK are even higher. It was quite interesting pre-COVID. We heard a lot of barriers as to why Australia was different. The dispersed population, the high unit labour cost. I often think it's actually some of the more simplistic barriers, and it's been interesting how the health crisis has ultimately removed those. And one of those is every time you ordered something, you had to sign for it. Now with the health crisis and social distancing, we have contactless delivery. So for those of us that live in detached dwellings, we get the doorbell pressed, the product's there, and we've not actually signed for anything. So something as simple as that is actually part of the contributor that accelerates this story. Food retailing, we think, is a really interesting one to watch. It's only 3.5% in terms of the e-commerce penetration rate. And again, that's another area we see an acceleration. Manufacturing, 6% or roughly 6% of the overall Australian economy. I'm not a big subscriber to the onshoring of manufacturing activities, but I do see the manufacture of product, whether that be pharmaceuticals, whether that be the hardware within healthcare, is certainly going to be a growth area of manufacturing moving forward. In the bottom left, we've put the lean inventory model. A lot of organizations move towards just-in-time supply chains. That's been happening over a longer period of time. Some of those supply chains have been challenged. We don't expect to see a significant increase in the amount of inventory that they ultimately hold, given the costs associated with that. But we do see some organizations moving slowly away from that lean inventory model. The risk factor that we see for the industrial and logistics sector, which I think is relevant when you think of commercial property more broadly, is around population growth and the scale back that we've seen in population growth projections over the next few years. If you look at industrial and logistics specifically, for every headcount, every person we add in Australia, we need 4.5 square meters of industrial floor space. So obviously that's going to lead to less asset creation in the shorter term. The other big evolution that we need to think about in the sector is what's happening around warehouse automation. And while we get very fixated on what Coles and Woolworths and Coca-Cola Amatil have been able to achieve, to me, a lot more organizations are thinking of parts of automation rather than the type of implementation that we've seen from those groups. So essentially, asset managers really understand their organizations that occupy their space by allocating the automation that they're doing to one of these 5 factors. And I think it's important to understand that because you really start to truly understand the underlying business of that particular organization. We also see the evolution of the sector more broadly. You know, cold storage, we would argue, has been a niche part of industrial and logistics. We see potential growth there moving forward. The image on the top right relates to data centers. I think we will see an acceleration of investor interest and demand for data centers as well. And then you've got some more of the minor players that are starting to think around that micro fulfillment piece. So Takeoff that have partnered with Woolworths, ultimately to look to do that micro fulfillment from the existing store network. And the one on the bottom right there is a group called Starship Robotics, who are using droid technology to ultimately do micro fulfillment within a 2 to 3 kilometer radius. Now, I just want to touch on retail quickly, because really retail, and in particular discretionary retail, is where we've seen the greatest challenges coming through COVID-19. A lot of these challenges were evident prior to COVID, and some of these challenges have now been accelerated as we're going through the health crisis. So I won't intend to go through every single phrase on this chart. We could probably spend the next 48 hours dissecting this, but there's a few interesting ones that are coming through around sustainable rent reset. We're now starting to see that within the larger shopping centres. Store rationalisation. But the one that really interests me sits a little further down, and it's called changing yield hierarchy. And we've historically seen a very clear hierarchy in terms of tighter cap rates applied to the larger shopping centres, followed by the mid-sized shopping centres that are reliant on DDSs, and then convenience retail and large format retail. I think one of the things to watch moving forward is, will we see a change in that hierarchy? Because those convenience centres through COVID have managed to have very high rent collection rates. Those larger centres have actually seen very low rent collection rates. So we may see a reassessment in the confidence in the cash flow and the risk premium that is ultimately applied to different retail categories. So the last part, and I'll go through this very quickly, is around what we're seeing in the investment markets. And the first of those questions is, how quickly will transaction volumes rebound? Now, we don't think looking back at 2008 is really a good guide in terms of the overall activity, but there is one key message which I think is relevant, and it's looking at global equity markets. And I've used the S&P 500 as a guide here. After the correction in 2008, it took until April 2013 for it to recapture its pre-crisis peak. That was almost the same journey that we saw for commercial property transaction volumes. So the denominator effect over that time period was very real for pension funds, that it saw a significant correction in the value of their equities holdings and were ultimately overweight real assets. Then we've got the scenario this time around. We saw the big crash in equity markets in March. We had a very strong recovery. It was a little bumpy last week, but given that unprecedented policy support, it has provided some support to equities. And we now see the potential, notwithstanding any risk around reinfection, that equity markets recover and we see a shorter pathway back towards pre-peak transaction volumes, not so much for 2020 or 21, but looking at 22 and 23. So one of the things I think that's really interesting is looking at property market discount rates tracked against the 10-year bond yield. And I'm using discount rates here as a proxy for return. And you can see when you look at this chart, there's a very strong visual correlation. Industrial and logistics and office has shown a correlation coefficient of 0.88 and 0.85 over that time period. The spread that we see at the moment is wider than historical benchmarks. And that's partly investors factoring in a partial mean reversion in the risk-free rate, but also the application of a higher risk premium given some of the uncertainty. It's actually interesting, and we're a big subscriber to Nikki's Business Outlook that they publish, and we've been looking at the 10-year bond yield forecast moving forward, and the average over the next decade, and the spot figure 10 years from now, is around 30 to 40 points lower. So given that's the risk-free rate when we start to think about real estate returns, once we see a normalization in the risk premium, that ultimately supports that environment around lower investment returns. Now, just very quickly, and this will take a long time to go through, so I won't do it. Essentially, what we're looking at here is potential growth within sectors and institutional interest. If you look at where industrial and office is sitting at the moment, we believe they're portfolio cornerstones. And you can see that institutional interest, which is illustrated by the x-axis, is very strong. It's strongest in industrial and logistics at the moment. We continue to see strong interest for CBD office, but the one to watch moving forward is very much going to be metropolitan office as we see an evolution in this hub and spoke. So they were the three questions that I had. you obviously get the material post this, but that's really the answers in terms of how we saw those three questions. So I want to thank everyone for listening and hand back to Steve in the studio.
Thank you for that, Andrew. Look, I want to apologise in advance. We've almost 500 attendees at this event. It's simply not possible to get through the questions. So for our external speakers, I'm only going to be able to ask a question, and you will see at the end of today's slides the contact details of Charter Hall. So I would encourage you to reach out, and anything that isn't answered today, please do ask us. So we've got a question here from Sally, Andrew. It says, Andrew, how do you reconcile workplace collaboration with a hub and spoke model where you have employees in different locations?
I think that's a really good question, Steve. I mean, ultimately, when we look at the hub and spoke model, we're not saying, 5, 6 locations. It's really around more that 2 locations, and then work from home forms part of the spoke as well. So I think it's that mix. I think for organizations, they're trying to find a utopia or some form of nirvana where they can actually get the balance right between flexibility for their people and collaboration. So I think it really depends on ultimately the size of organization, the type of activities they undertake. We don't think hub and spoke is relevant for a number of organizations. We do, as I said, think you have to be of a certain scale. And I think that's ultimately going to be what we see the consultants to those organizations is trying to navigate a pathway towards getting that balance right between flexibility for people. Often we hear the flexibility is flexibility on their terms, and actually that the workplace strategy that goes around it. So it's going to be a really interesting area moving forward, Steve.
Fantastic. And look, thank you for those additional insights as well. I'd now like to introduce our third speaker for today's session, Nikki Hutley. Nikki is a senior partner at Deloitte Access Economics. She's a highly experienced economist with broad-based experience in macro and microeconomic modelling, as well as analysis gained over nearly 3 decades of practice in financial and investment markets. She's worked with all levels of government, as well as the private sector, not-for-profits, and Nikki's work has encompassed issues as wide as modern slavery, housing affordability, and climate change. She's very passionate about improving the quality of lives from an economic and social and environmental perspective through well-reasoned policy. Please welcome Nikki Hutley.
A very warm welcome from me to everyone as well on this somewhat chilly winter day. Look, I'm going to talk today about what we call the 3 phases of the COVID response from a broader macroeconomic perspective, and then tie that back hopefully to the property sector as we go along. But at Deloitte Access Economics, we talk about 3 phases, the respond, recover and thrive. So respond equates to where we are now, recover, of course, the way out of the recession that we are now in, and then looking to thrive over the horizon. What's going to change? And of course, Andrew talked a little bit about that in his presentation, and I'll hopefully add a few more dimensions as we go along. But I think the thing that I want to start with this morning is to remind everybody that this is first and foremost a health crisis. So for those of us old enough to have lived through the 91 recession, which Paul Keating, Treasurer at the time, called the recession that we had to have, with the greatest of respect, this actually was a recession that we had to have. We could not afford to let the economy, let people go out and about without any restrictions. If you want to know what that looks like, just take a look at Brazil, Russia, and many of the other economies that are at the top right-hand side of this chart. What you can see over time is that many countries, through imposing physical restrictions, I like to call them physical rather than social, hopefully we remain socially connected, but those physical restrictions have had really good outcomes for those that have implemented them in terms of health. But of course, the economic consequences have been dire. Now, I don't want to bombard you with too much negative news, but I do want you to understand, and I think it's important, where we're coming from so that you can then see what the pathway out looks like. And so we need to have some sort of that context. And in fact, just in the last 13 minutes, we had the May labour force numbers popped up. The unemployment rate only increased to 7.1%. And we saw last month it only increased to 6.1%. And that's because so many people have actually dropped out of the workforce altogether. But this is an ongoing problem, and I'll get more into the detail of that in a minute. But we need to be a bit careful sometimes in interpreting some of these statistics. But let's just go through a few anyway. And I think sort of the central points that I want to make are services sector has been hit obviously the hardest. We've had exemptions for mining. Some manufacturing has continued with some distancing in place and some changes in measures. But you can see from the CommBank Purchasing Managers Index that on the services side, that pink line very much seriously contracting, even though we're seeing some little comeback as restrictions start to be lifted, versus manufacturing. And of course, manufacturing is much less of an important sector in the Australian economy, being only about 7 to 8% of our economy, particularly in New South Wales. So not such an important sector for us. And unfortunately, that downturn, the really big hit to services, has really made our economy much more vulnerable because of our exposure, both in terms of the household services sector and, of course, business professional services, including financial services. You can see, some 74% of businesses are reporting to the Bureau of Statistics, the ABS, that they have in some way been impacted, had their revenues impacted. 72% of companies a fall in revenues, 22% down, and of course 7% up. It's an ill wind that blows nobody any good, and in certain sectors, particularly the infamous loo paper debacle, if you like, some sectors have seen their sales, in fact, go up during the course of this crisis. But it is very much a tale of several cities and also, of course, different sectors. You can see on the left that, as we would expect, the arts sector, accommodation, hospitality sector, tourism are the ones that have been most affected in terms of job losses from the payroll data. But you can see that nobody or no sector has been untouched. And before somebody asks why information, media and telcos is down, given how much extra streaming services and bandwidth we're all using, that's because the media sector also includes film and television. And obviously those production style houses have been very adversely affected as well, not being able to produce our favourite shows or a great deal of content, in fact, has been stalled. If we have a look at the map of Australia on the right side of this chart, for those of you that can see, we note that New South Wales was most heavily affected in the March quarter. And you can remember that this is before we saw the really big impacts from COVID, which we won't see until we get that June quarter data. But of course, New South Wales was already being adversely affected by both droughts and then bushfires, and then got the triple whammy of the COVID. So talk about a perfect storm. Where we really have seen some devastation to that economy. Clearly, that's the worst hit. Interesting to see in the Wild West that they've almost seceded from the rest of Australia. That even though they've been adversely impacted, of course, in the tourism sector, the role of mining in keeping that state going has been critically important. Other states much more vulnerable to tourism and of course the services sectors more broadly. There are lots of things that we weren't able to do for several months, but of course now we're starting to see the economy starting to open up, and we're hearing a lot of people talk about green shoots. And so whilst I would equate this COVID crisis a bit like a hurricane. Yeah, when you're in the eye of the storm, there's devastation everywhere. The storm itself might pass through quite quickly, and certainly we have lifted restrictions much more quickly than anyone anticipated. The health outcomes have been far, far better than the sorts of modelling that we were looking at back in March, which were really dire. If we were going to end up like the US, it would have been absolute, just, a catastrophe for us. But barring a second wave, we've come out of this much more quickly. But as with the hurricane analogy, even once the storm passes, we might still see for quite a while the tail end of rain and wind. And then, of course, even once that might calm down and the sun starts to come out, there's still a massive cleanup to do, and that can take months and months. And that's much the same as what we're seeing with this crisis. Even though the worst of restrictions appears to be over, we will still have fallout consequences for quite some time before we get back to normal. Deloitte Access Economics modelling suggests that we will not get unemployment back to normal levels, including getting people back into the workforce, not just recovering the number of the unemployment rate itself, but recovering those nearly 1 million jobs that have been lost. Will take probably 4 to 5 years to get back to full operational level. And in fact, some sectors may never come back because, as with many parts of COVID, previous trends that were underway have been accelerated. Things like online, the way we communicate. Andrew already talked about how we have more flexibility embedded, not necessarily everybody working from home 7 days a week or 5 days a week, hopefully, but definitely concur. I know my young team are the ones that are most desperate to get back into the office and have that collaborative spirit. And as part of my work in urban economics, we talk about and can measure the benefits of agglomeration, those casual bumping experiences that create fantastic ideas, better collaboration, the ability to read body language. It's really important for people to have that physical connection. So Zoom is great and great for these sorts of opportunities to keep talking to people, keep up that social connection. But we look forward to seeing things come back to normal a little bit more as we go on. But as I said, some of these trends that have been accelerated, particularly around the use of technology, thinking about agricultural sector, manufacturing, and mining, those sectors are seeing potentially long-term structural adjustments in employment, and we're likely to see more employment in services sectors, which means we've got to be really careful in thinking in the future about our vulnerability, not just to perhaps more frequent pandemics, but also obviously the consequences of climate change. But I'm getting a bit ahead of myself here, and I'll just jump back to those green shoots that I mentioned. And it is good to see that both business and consumer sentiment are responding positively to the lifting of restrictions and the greater flexibility in movement that we're all starting to be able to enjoy. Some, obviously, states and territories more than others, but we're starting to hear about border restrictions either about to be lifted or potentially being lifted a little bit further down the track. South Australia, of course, heading the pack with those lifting in restrictions. But I would caution again, we have seen some increase in community transmission, yet another case from the Melbourne protests the other weekend. We're seeing in China now a second wave, in parts of the US, a number of second waves there. Whether they're related specifically to protests or not, we don't know at this stage, but certainly that won't have helped. And if Australians get a little bit too lax, we've suppressed the virus, we have not eliminated it. And if we do get into the stage where we start to get a rapid rise in figures, we need to be watching in the coming days to just make sure that we keep that under control, and we don't need to see, not so much, I don't think, restrictions imposed at the level that we had a couple of months ago, but potentially a much slower way out, and a much slower, a much longer trajectory, if you like, before we get to the full stage 3 lifting of restrictions. But getting back to those green shoots and that little sign of positivity, of course, we've had so much support from government, whether it's monetary policy and financial system stability from the Reserve Bank of Australia. We're going to see interest rates, low for long. They've been very clear in signalling that you shouldn't expect interest rates to rise. Not so good if you're a retiree, perhaps relying on some of that. But for those of us that are net borrowers, that will be, help to stimulate demand as confidence grows. Obviously, tremendous amounts of policy from federal and state governments, and also less official support in terms of the banks and what they've been doing in terms of mortgage and debt holidays, property owners in terms of rent holidays. Now, those are going to come back talking about, the hurricane effect and things that are still lie ahead of us. Come September, when some of the, the majority of government support goes, banks start to reassess the way they've addressed, put those holidays in place, the way some of the rental holidays come off. That's going to have some adverse consequences again. So whilst I wouldn't quite call it a double dip, we should be cautious, and we can very well expect that come September, the data might look a little bit better as we approach September, but then in September quarter itself and those coming months, we're probably going to see a little bit of a, two steps forward, one step backwards as we adjust and pull away that tremendous amount of support that's been happening. And of course, we've just seen figures out on the last day on international travel, with no net migration of any consequence, and with probably an even further decrease in the natural birth rate. That's going to have big consequences, not just for the construction sector, although housing and construction will definitely feel the brunt of that, particularly as we get towards the end of this year and pipeline starts to run out, but also just for generally for the population serving sectors, those service industries. Again, they're going to have much slower growth because, of course, population growth is a core part of our economic growth story in Australia. So again, some little words of caution. Yes, the green shoots are there, but I keep saying, just beware. Now, the IMF and the OECD are telling us we're probably going to have something of a good bounce back. I know the IMF is about to readjust their more recent forecast, and it's not going to be so V-shaped. And in fact, Deloitte Access Economics forecasts we've actually got what we call a question mark shaped recovery, because a lot depends. At the moment, it looks like we're somewhere towards the left of this chart. We've got the good, the bad, and the ugly, somewhere between the mild and harsh scenarios. I am a bit worried about, with how businesses are and their plans for investment, but probably a little bit more optimistic about the consumers, and certainly what we've seen in terms of retail spend. The credit card data that's coming out looks like a lot of sectors are coming back. But we still have obviously higher levels of unemployment. And as I said, once those government support levels come off, even if you're going from, JobKeeper to JobSeeker, that's still a couple of $100 a week less that you're going to have. And if JobSeeker gets cut back more towards New Start levels, which I certainly hope it won't, but seems quite likely that there'll be substantial reductions, that's going to be an even further decline in income for a lot of households. And we know that basically those things have been what's keeping retail going. Those payments and the stimulus payments, in addition to JobKeeper and JobSeeker, are the things that have been driving spending in the shops at the moment. So you can see that even with a reasonable scenario, we're still looking at contractions of somewhere around 5% this year. If we get the second wave, we get increasing social unrest, businesses become even more concerned and pull back their expenditure, then it could be a much heftier decline. But at the moment, things are, touch wood, looking a lot more optimistic than they certainly were. And sorry, conscious of time, I'm not going to talk too much about the future, because I think Andrew covered a lot of these things. But one of the things I do keep pointing out to people, I know COVID is everyone focused, but there are a lot of lessons around COVID from a sustainability and climate change point of view, and understanding future risks from climate style disruption. And it's something that the property sector is going to really need to think about in the future, and just exactly what those sorts of risks look like. And of course, finally, just talking about, we've heard the government talk about some of the policies that we expect to change in the coming year: industrial relations, the need for better skills training, more focused, cuts in red tape, and of course taxation. You know, are these things going to be productivity enhancing? Are they going to be genuine reforms? It'll be interesting to see. I remain sceptical, but a little bit of cautious optimism, particularly around industrial relations, given there's been a bit of détente there between business and the union sector. So let's hope that we can see something positive there. And of course, then, you know, the government is going to need to stay involved in the sector. We heard the Prime Minister on Monday talking about big infrastructure spending as well as smaller regional projects. We're very much in favour of those shovel-ready small regional projects as a way to help the property construction sectors to keep going as they face difficult times ahead. We're going to need to see more of that in the future. Thanks very much.
Look, fantastic insights into the broader economy, Nikki. Thank you very much. And at Charter Hall, we're always interested in hearing from experts like Nikki because it does help shape the strategy of the group, the type of assets which we look at over the longer term. Nikki, we probably just have time for one question here. We've got a question from Lisa who said, you mentioned interest rates are lower. What do you think the implications are for them being lower for a long period of time?
Yeah, well, obviously the biggest implication is around asset prices and people seeking high yields. And it's kind of interesting, I think, you know, what we're going to see. We've seen obviously the equity markets really look to try and grow to keep recovering those losses and to find the good story coming out because they're trying to compensate for those lower yields and from interest rates. But it's possibly they're getting a bit ahead of themselves. I think one of the good things for Australia is in terms of the residential sector is that it will help that sector when we've got so many other forces potentially seeing not only new activity but also general demand and prices facing some softening trends. So yeah, there's going to be a real chasing of yield, and that will continue to happen for a long time. But, you know, it's a good thing for governments facing debt. It means that we should be borrowing more on the infrastructure front, and that's good. And it also means that for the corporate sector, who, you know, often are quite cautious around what the return on investment might look like for their investment strategy, it's certainly that lower cost of capital is a positive.
Well, look, thank you again, Nikki. Really appreciated your time today. Look, this brings us to the final presenter of today, which is myself. I'm going to give you a little bit of an overview of the Direct suite of funds. I'm very conscious of the funds that we have in terms of number and the level of information that investors want. By necessity, I will be brief. There will also be a whole bunch of numbers up on the slides here. I'm not even going to try and go through each point, but the reason why we've included them is because it does allow for investors, if they want to look at this presentation again when we put it up online, you can pause it and pull up the information you need. So the first thing I'm often asked, and my team's asked, well, Stephen, how are the funds performing? Importantly, the slide you can see on the screen right now is the core, so the institutional grade, the long leased high occupancy portfolio, which we've been invested in for a long period of time. And what you can see here is the blue bars are the fund level returns of each individual investment versus the grey bars, which are the benchmark returns. The other thing I would say here is we've split up this table, as we usually do, into the fixed life funds, which have a finite term. And on the right-hand side, you can see the funds which are still open for investment. Importantly, at Charter Hall, we very much believe in being transparent and giving investors up-to-date information. So on this front, we had all the assets independently valued at either 31 March or 30 April, and we're going to get them all independently valued again at 30 June. We think that's the best way to give investors confidence around the unit pricing. The other thing to note, I've had a few questions offline around when will I know what the distributions will be for the next financial year. What I would say is we're going through the usual bottom-up, property by property, fund level budget process. We'll get those budgets approved by the end of this month. And then as we hit the June quarter, in the quarterly report that's mailed out to investors at the end of July, we'll give guidance on each of the funds in terms of their outlook for distributions for the next 12 months. The next slide shows the performance of the Folkestone funds. So as you know, Charter Hall and Folkestone merged 18 months ago. What you can see here is the funds have performed generally very strongly. The only two I'd just draw your attention to where the actual results are materially less than the benchmark, you just need to keep in mind that these are development assets where either the development hasn't yet completed or it's recently completed and those assets are in the lease-up phase. So there hasn't been any opportunity to reflect any capital appreciation on those. The other thing worth noting is that the high-quality Folkestone team, who many of you would have been dealing with on these funds, so Ben, Adrian, Scott and Lula, are still actively involved in all of these funds, and I know that, and many of you have been speaking to them on an ongoing basis. I'm now going to quickly cover off our fixed life core funds. This slide shows our retail assets. So in that, you've got your Bunnings and your Direct Automotive Trust number 1 and number 2. For those who are in the Automotive Trust, you will be aware that at Charter Hall, we really needed and wanted to work with our tenant. We allowed them to defer some of the rent, so the rent isn't lost, but it just allowed them to work through some cash flow issues that any business tends to have when you forcibly are shut down for a period of months, or even if the business was still operating, when the government's telling people not to leave their house or socially distance, it makes it very hard to turn a profit. So what you've seen there is we've helped the tenant, which is ultimately in investors' best interest, and again, importantly, none of that income is lost. And the Bunnings Trust, about 18 months ago, we extended all the leases back out to 10 years, and that trust keeps going from strength to strength. Here are our fixed life industrial funds. Those investors who are in CDC Trust, which has a significant interest in the Coles Adelaide Distribution Centre, would already be aware that the asset management team recently achieved a new 15-year lease with Coles, which created a significant valuation uplift, which is why you'll see those 12-monthly returns so high. And it's really positioned that fund, which is great because we're now at the end of the 6-year investment term for that vehicle. So for those investors who are invested, look out in the mailbox, look out in your inbox. We'll soon be mailing you an update and management strategy around that exit. And I think you'll be very pleased in what we've been able to achieve for investors there. In terms of Diff 2 and Diff 3, well, look, they're doing everything they should be doing. With long leases, well in excess of 10 years, 100% occupancy and strong tenants, they continue to provide that regular and growing income stream for investors, as well as that capital growth as those fixed rental escalators kick in each year. This next slide is our latest fund. It's called the Charter Hall Wholesale Property Series number 1, or WPS1. It's much easier to use the acronym. Many of the funds that this invests into, you need either a $20 million to $100 million investment. So the wholesale funds, 20 million plus. Our partnerships and mandates, 100 million plus. So what we've gone to a lot of effort to do is to lower the entry point to make this highest quality funds available to our high net wealth clients. This brings me to our flagship fund, the Direct Office Fund. It's been in existence for the longest term, back to 2006. It's over $2.2 billion. You can see there, I won't go through the key stats on occupancy and lease term. There's a very consistent thematic. Anyone that's heard me speak will have heard the same thing. We focus on long-term leases, high occupancy levels. All occupancy levels exceed the Property Council benchmarks. But what's really important and what's shown in the crisis like we've seen is It's just as important who's paying the rent. So you can see there on the slide, the top tenants are government. Almost 30% of the portfolio's net property income is paid by federal or state government tenants. That's terrific. And why am I mentioning that? Well, it's terrific because they have the highest credit rating and the government will always pay you the rent. If you then go down, you see other tenants such as Suncorp, Coles, Western Sydney Uni and Westpac. This isn't an accident. You heard from David at the start. We've been very deliberate in achieving this strategy of long leases to strong covenants because we believe that's the best way to continue to deliver income for investors. The PFA fund, again, the biggest tenant, over 50%, government tenants. The fund has now grown to over $1.2 billion, and we recently secured a new development in the Innovation Quarter out at Westmead, near the big hospital, underwritten by the Western Sydney University and CSIRO as key tenants. Again, going down, you can see the other tenants, American Express, Aurizon, a huge company, Lion. Those top 4 tenants are around 75% of the net income of PFA. Moving through to our open industrial and logistics fund, and I should mention both DOF and PFA are also open for investment. We've consistently grown this. We've taken the themes of what we did in industrial fund number 2 and 3 and simply rolled them out into number 4. At $600 odd million of gross asset value, this fund is one of the largest unlisted industrial funds available to high net wealth, self-managed super funds and retail investors. The tenants, Mainfreight, you often see their trucks going around. Well, who are they? They're a $4 billion market cap entity listed on the New Zealand Stock Exchange. They do basically logistics, third-party transit, and it's a big growth area. Primo, largest small goods, so meat processing company in the world, as well as Ingham's, another key tenant, basically a duopoly in this country between Ingham's and Steggles, and that benefits from a very long-term lease, which is great for investors. What I would say with industrial and logistics, you do tend to get longer lease terms than what you can achieve in the office sector. It's just a function of those markets, but you do tend to also have slightly lower fixed rental increases coming through. It's not that one's better or worse than the other, it's just different factors in those respective markets. The next fund, DCSF, well, look, for those investors in this fund would be aware we've had to temporarily reduce the distribution rate. There's no shying away from that. Although we set this fund up to be extremely defensive, what's happened for those properties that are located in CBDs, such as the Brisbane CBD, we've got a government that's rightly closed it down and office workers being non-existent. Obviously, what we're trying to do there is help tenants through that short-term cash flow process. And even after those reductions, it still is achieving, as we stand here now, a 5.6% income return for investors. So this fund pays monthly distributions, and we don't expect that reduced distribution to continue. It's likely that we'll wait for a period of time till we've got more confidence on where the pandemic situation is, and then later on in this calendar year, those distributions will be increased. The next slide is something which we haven't necessarily focused on previously, but it is an important piece of an investor's portfolio. So the funds I've been talking about so far relate to unlisted funds, so they're not on any stock exchange. Well, pleasingly, we've now got a very high quality fund called the Maxim Fund, over $160 million of stocks. And what it does differently is it invests into the listed real estate markets on the ASX. So what the big difference is that it provides liquidity and is a lot more liquid property exposure. Having said that, just because there's liquidity doesn't mean you should trade in and out of something on a weekly, monthly basis. Like you'll hear from any good financial advisor, investments should be considered over the appropriate timeframes. You can see it's very well researched externally, and the returns continue to beat the benchmarks that's set for that fund. So I'm not saying that Maxim is a better option than the unlisted funds or unlisted are better than listed. What I would say is they offer different points of difference for your portfolio. If you're after exposure to a listed market that's liquid, well then perhaps Maxim's something worth considering. If you're happy to invest into a product that will lock your capital up for 3 to 5 years, depending on the review event, then the unlisted may be something that you're interested in. And finally, I'm just going to wrap up with a couple of recent acquisitions. I think giving people a real understanding of what we've been buying and the rationale gives you an insight into our thinking at Charter Hall. So the first asset you can see there was acquired by Diff4. We teamed up with our $5 billion industrial wholesale fund, and it purchased a long-leased asset in Erskine Park, a core industrial market west of Sydney, on a long-term lease, 100% occupied, and that's a real core asset for that fund. You will have seen on my cover slide, which I've repeated here, the PFA's most recent asset out at Macquarie Park, underwritten by a long-term lease to the New South Wales government. You've got a WALE, again, weighted average lease expiry of almost 10 years. And as I said earlier, the benefit of having government tenants is you have certainty that they'll continue to pay the rent through all different cycles. And as I've been asked before, well, what happens if the government does stop paying the rent? I say, well, they're contractually obligated, and if that case ever happens, this will be the least of your concerns. And finally, some recent acquisitions we made earlier in this calendar year in DCSF. We picked up 2 healthcare trust or assets on 10-year lease terms. So that's the kind of defensive asset class which we like. Long-term lease, high occupancy, strong tenant in Helios, and providing exposure to that healthcare sector. I've put up on the slide here the contact details of the key team members that are involved in Direct Investors. You can also see on the right-hand side our general investor number, as well as our registry details. The registry I encourage you to contact if you need some administrative things around investment statements and so on, unit prices. And you can see there the bottom line, our team, if you have any questions. And I mention that because I am very aware we've been inundated with questions, but due to time constraints, we simply don't have the forum here and time to get through them all. So with that, I'd like to close. I'd like to thank you for joining us at the 2020 Charter Hall Direct Market and Fund Update. I'd also like to thank our guest speakers, David Harrison, Andrew Ballantyne and Nikki Hutley, for their insights. We'd love to get your feedback on today's event. We are very much focused on educating our audience, and for those that have dialed in today, you will receive a 2-minute survey. Please, if you can, fill it out. We're very focused on improving the experience, and we want to cover off the topics that are of most interest and relevance to you. Thank you very much for joining this event.